everybody. Thank you so much for joining this webinar. I am Brittany Mann. I am the Senior Digital Marketing Manager over at Stock and Option Solutions. We are going to have a webinar today on unlocking the secrets to Section 16 compliance, and I'm going to pass the torch over to Christian Bell, who will introduce the presentation as well as his fellow presenters.
Well, hi, my name is Christian Bell, and I'm here today with Alan Dye and Trevin Rard. And welcome to Unlocking the Secrets to Section 16 Compliance. We're excited to share some ideas with you today that we hope will challenge you and help you to think about your work with this population in a fresh way. So I've worked in equity compensation 20 plus years, supporting U.S. and international clients both. My focus at SOS is ensuring as an outsourcing provider that we provide the right process management so that our clients are successful, so that they enjoy the full value of their equity compensation awards. And we do that by providing peace of mind. Trevin?
Hi, I'm Trevin Rard. I'm currently at Remitly and have been with the company for 2 years. I have over 25 years of executive assistant experience and over 10 years of stock administration experience. So I'm very familiar with helping Section 16 officers through their equity processes.
Thank you, Trevin. Alan?
Yes, my name is Alan Dye. I'm a partner with Hogan Lovells, an international law firm, but I'm in the DC office. I've been with the firm in the public company advisory practice for about 35 years or so. And before that, I was in the Division of Corporation Finance in the chairman's office at the SEC. And while at the SEC, I worked for Peter Romeo when he was chief counsel. He's a retired Hogan Lovells partner, and he and I together have published a number of publications on Section 16 compliance.
Thank you, Alan. Appreciate that. All right. Well, for starters, anytime we're talking about how to properly report insider activity, we need to recognize the stakes are high and the consequences can be quite serious if mistakes occur. Typically the risk is extended primarily to the insider and the client, but due to the very visible nature of the work that we do, it can also shed a really bad light on the stock administrator as well. So let's start by looking at some of the basics and some of the foundational pieces of this process before we dive into the weightier issues. Alan, would you speak to this for a few minutes, please?
Sure, I'm happy to. There are 3 basic Section 16A reporting forms, and these reporting forms have existed since 1991. And it's important to be aware of not only for whom your filings need to be made, but what's the correct filing to be made, and as we'll get to later, what's the deadline for getting that report on file. The initial report for any new insider of a public company, and by insider, I mean an officer or director or someone who beneficially owns more than 10% of the company's stock, it is the Form 3. The Form 3 takes a snapshot of all of the securities that the individual owns at the moment of becoming an insider. And it's due within 10 business days after the person becomes an insider. The next form to be aware of, and that's the more likely form to have to be filed first, is a Form 4. And a Form 4 reports any change in the insider's beneficial ownership of the company's equity securities, which includes options, RSUs, and stock as well, is required when there's been a change in the number of shares reported in the Form 3 or the number of securities reported in the Form 3, and that's generally due within 2 business days after the reportable transaction. And while I see that our slide shows Form 4 as the 3rd form, there's actually a Form 5 that's the 3rd reporting form, and a Form 5, which is new as of 1991. I know that doesn't sound new, but the other forms since about 1934 and 1935. But Form 5 is essentially a cleanup form. It isn't required for every insider every year, but Form 5 is a form to be filed if there were transactions during the prior fiscal year that were eligible for certain exemptions from Section 16B, and as a result of that exemption could be reported on a deferred basis on Form 5. Form 5 is due 45 days after the end of the fiscal year. The other purpose of Form 5 is to report a transaction that should have been reported earlier in the year, within 2 business days on a Form 4, but because of a mishap, it wasn't reported on Form 4, and so it gets included on Form 5. Would you like for me to address the consequences of?
Absolutely. Yes, sir. Thank you, Alan. I appreciate
All right.
that.
Right, so the importance of getting all of these forms filed and filed on time is primarily that a failure to report a transaction on time, either on Form 4 or Form 5, or to report a holding on Form 3 on time, is that late filing triggers a disclosure obligation on the part of the company. So if there has been a late report filed or a failure to file a required report during the fiscal year, the company's Form 10-K and proxy statement need to include a special disclosure of that delinquency or all delinquencies. And those disclosures appear under a specific caption. That's not an attractive statement. And that disclosure has to identify every insider who was late in filing a report, the number of transactions that were reported late, if they were late Forms 4. And so while it's a somewhat common disclosure because mistakes happen, it has the potential for not just having to make the disclosure, but having the SEC aware of your failure to file reports on time, which can attract a Section 16A enforcement action from the SEC. And maybe equally important, if the failure is on the part of the compliance person and not the fault of the insider for failing to bring a transaction to the compliance person's attention, the insider can be very unhappy to see his or her name in the proxy statement as a securities law violator.
That makes sense. Thank you, Alan. I appreciate that. Well, this next slide has some interesting data from a 2022 survey as to which departments primarily handle Forms 3, 4, and 5. And as you can see, in-house counsel, stock administrators, outside counsel, corporate secretaries, they're top of the list, and that's primarily what we'd expect. From an SOS perspective, as a third-party filer, we see the same thing, and we often see multiple stakeholders all working together, sometimes on the same form, and everybody has the right approach, wanted to do the right thing, maybe a different way of looking at it. So it's important to have those processes predefined and outlined, and make sure you have a good final decision maker in that process. Trevin, what are your thoughts on this?
I think the key one is to note that there are 0% of the insiders that are filing these forms on their own. And so I think the important thing really is to make sure the insiders are reminded and aware that the filings are going to take place, giving them a chance to take a look at that data, and also incorporate or include what I would call their posse, the people who are advising them in those filings, just so they know and make sure that they have access to those. I would also say some other key things are the consistency of filings, making sure things happen the exact same way every single time so that things aren't missed. Also, a couple interesting things of the power of attorney delegation. You are able to have more than one person included in that power of attorney delegation, which is a great way to avoid any misses if someone's on vacation or out sick and you need to have a filing happen in a very short period of time. You have that backup person who's able to file on behalf of the insider. So I think those things are really important. The other one I would add is to include all your internal partners. So making sure your payroll team, your tax team, your legal team are aware of those filings if they're not filing them for you.
That's great, Trevin. Appreciate that. So for this next one, let's just talk about getting started and having a plan to ensure that you put your insiders in your company in a really good position for success. Trevin, could you speak to this one as well, please?
Absolutely. I think just some of the key things that are important on those forms that Alan talked about are EDGAR and CIC numbers and the timing of these form filings. So for instance, if you have a brand new insider coming into, or Section 16 officer coming into your organization, try to get that information as quickly as possible, because not having those Form 3 filing pieces of information If there's an insider who has a grant immediately upon starting with the company, you turn that Form 3 window from 10 days down to up to 48 hours. So because you've got a Form 4 that files directly after the fact. So getting that information in advance, making sure you understand what kind of tax treatment that insider wants, whether it's net share withholding, sell to cover, if they don't want any taxes withheld, to find out who is going to give you that data so that you have everything ahead of time. And then again, consistency is really, really important. The other thing I would find out is if the insider is coming in or is being named as an insider, do they already have a 10b5-1 plan in place, and making sure you know what those nuances are and understanding. So again, you're setting yourself up in advance to know when activity is going to happen.
That's really good, Trevin. Appreciate that. Alan, did you have anything you wanted to add to this one?
No, I don't. I thought Trevin covered it very well.
Perfect. Thank you both.
Thank you.
All right. Well, let's see. So this one I think is really interesting. It's a topic that I've seen on a number of threads and dialogues, and it's related to awarding a new RSU award that's solely payable in stock. And there's a couple of ways to do this. And I think this first, just kind of make it clear, there's no right or wrong answer here on those two different ways of doing it. There's just different consequences and ways to think about it. There's one approach that will say, you know, let's do the new award, let's do the vest all in table 1, and let's do that in one filing. And that works great, especially for directors and consultants with no taxes. And that can minimize some risk just with that one filing. Another way to look at it might be, let's put the new award in table 2 and move that to table 1 once it vests. So there's just different ways of approaching it. And, you know, Alan, I'd love to hear your thoughts on how you approach this.
Sure, thank you. When the rules on reporting were amended in 1991, the staff issued in the next 2 years about 290 interpretive letters to explain to people how to comply with the reporting requirements and a number of other issues as well. And among the letters that the staff issued were ones that addressed the reporting of restricted stock units. A restricted stock unit, the staff said, is always a derivative security. And table 2 is where awards of derivative securities get reported. But the staff issued another letter and said, look, if your RSUs can settle only in cash, only in stock, and neither the company nor the insider can elect to be paid in cash, then it's the equivalent of a share of common stock. And so you have the option, and the insider has the option of reporting the award in either table 1 or table 2. And different companies take different approaches, as Christian, you said. The benefits, as you said, Christian, are of reporting in table 1 are is that you file one Form 4. Personally, I prefer this approach, but people have their own preferences. I like to minimize the number of filings that I have to make. And so if you can report the award in table 1, then why not? Because it does mean that you don't have to file a Form 4 to report the vesting event. That doesn't really help, though, I recognize, if you have a tax withholding provision in your RSU awards, because you're going to have to file a Form 4 to report that some of those shares were withheld to pay the withholding tax obligation. There may also be a need to report on a Form 4, even if the insider has paid the withholding taxes in through some other means, including if there is a sell to cover attached to that award. Because if the day that the RSUs vest, a number of shares are sold into the open market to pay taxes, and that open market sale has to be reported on Form 4 as well. But you know, I know there are reasons for preferring table 2, and Trevin, I'll turn to you to let you address those benefits.
Yeah, I think this is the topic that has caused the most conversation and discussion back and forth with the SOC team as well as our internal legal team. Because they're derivative securities, I know our legal team prefers that we file in a table 2 for the first round and then refile as a table 1 once those shares vest. I think that's mostly because we do withhold shares to cover those tax responsibilities. And so I like you said, Alan, I think it's a personal preference. It's what your team prefers. It's what your legal team prefers. Just as long as you make sure that those filings happen is the key.
Yeah, those are good points. Let me add one other thought. I mean, this is not an RSU issue, it's a deferred stock unit issue, but the staff treats deferred stock units under a deferred compensation plan in the same way that they treat restricted stock units. And there, some insiders would prefer to report those in Table 1, even if they report RSUs in Table 2, because they like to show a bigger number of shares beneficially owned. In Table 1, it shows that the insider has skin in the game. And because those deferred stock units are typically paid out after termination of service, you don't have the same issue of having to file a Form 4 on the vesting date.
That's amazing. That's a great point. I will take that back. Share that with our team.
Yeah, that's fascinating. This one really stands out to me as one that I've enjoyed kind of learning from listening to both of you. So I appreciate that. Well, so with ESPP, that's typically not terribly complicated. But from what we've seen, there are different approaches and preferences related to reporting ESPP activity. Most of our clients will follow what's required, which is just to add a footnote in the next required filing, showing the activity and showing the new addition of shares. But we do have some individuals that prefer to file a fresh new form, when activity occurs. So, Alan, what are your thoughts related to ESPP?
Yeah, well, my first thought, Christian, is that the company or the compliance person needs to make sure they understand whether the ESPP purchases need to be reported as they occur. For most employee stock purchase plans that are pursuant to a company registered S8 plan, the plan complies with Section 423 of the Internal Revenue Code, and so clearly there is an exemption available from the obligation to report those transactions on Form 4. If the company has an open market stock purchase plan, which are relatively less common, but some companies do have them so that employees are contributing money to the plan and that money is being used to buy stock in the open market, there's a staff interpretive letter, which the compliance person should become familiar with to make sure that that interpretive letter, which says that some open market stock purchase plans do qualify for the exemption. So determine whether you have to file a Form 4. Obviously, in some circumstances, if you don't comply with the conditions in that staff interpretive letter, then you would have to file a Form 4 for all of your stock purchases. But assuming that you have the exemption available, again, my personal preference is why would you? I don't want to make it sound as though I'm questioning the judgment of those who do. And I think I'm always trying to minimize the number of Forms 4 I have to file. So I think if I don't have to file one, I will wait. And I'll do as you suggested, Christian, when the next Form 4 gets filed to report some other transactions, we'll boost the number in column 5 of Table 1, the number of shares beneficially owned, and then explain it in a footnote. This includes X number of shares that were acquired since the last Form 4 under the company's stock purchase plan. I do recognize that some compliance personnel like to file a Form 4 for each acquisition I've heard different explanations for it. All of them make sense to me, depending on a person's personal preference. Some want to make sure that every acquisition that an insider has is reflected in a Form 4 as an acquisition. They just feel like it better informs the market and it helps with their internal record keeping to do that. And they want to get that information out there, particularly since it's an acquisition. And again, on the theory that it's a positive disclosure to the market for insiders to be shown as purchasing stock. They like to report on Form 4, even though they don't have to.
That's great insight, Alan. I appreciate that. Trevin, did you want to add anything to this one?
No, I think Alan nailed most of the points. The one that kind of caught me that I thought was the most important was, not losing track of those acquisitions and making sure that you capture them somehow so that they can be reported at any point in time and not just letting that go all the way, to the side. But the other thing I would say is, the thing I've learned the most importantly is, when ESPP purchases are going to happen. So keep everybody that you work with in the loop. So if you're not reporting them as a stock administrator, you remind your legal team that that's happening and just make sure that everyone is aware of what's going to come and how quickly it will happen. So that if you do decide to file that Form 4, you have enough time to adequately have that take place.
Perfect. Thank you so much. So with DRIP programs, I guess kind of similar to ESPP programs. I don't know that it's one of the more complicated types of activities to think about from a reporting standpoint, but I know there are nuances for when reporting is required and exemptions perhaps for when it's not required. So Alan, if you could talk us through that a little bit, please.
Sure. What's important about acquisitions under a dividend reinvestment program are making sure that those acquisitions are exempt if you're going to have your insiders participating in them, because there's going to be a quarterly or other periodic acquisition for all of the insiders who participate. So that's a lot of Forms 4 to have to file if you're in a plan that doesn't qualify for the exemption. The exemption in Rule 16A11 is pretty simple to comply with if it's a company-sponsored dividend reinvestment plan. Essentially, as long as the plan is open to all of the company's shareholders, on a non-discriminatory basis, as almost all, maybe all are, then the acquisitions don't have to be reported on Form 4. So it's fine to let your insiders participate in the dividend reinvestment plan. You don't have to file Forms 4 each time there's an acquisition. And you would, as a Form 4 is filed, just again, add the number of shares acquired under the dividend reinvestment plan to column 5. And as Christian said, you would drop a footnote, presumably, and explain this includes X number of shares that were acquired under the dividend reinvestment plan. The importance of having a Rule 16A11 exemption for dividend reinvestment plan acquisitions isn't really whether the insider is participating in the dividend reinvestment plan, because often they don't. It's that if you don't have a Rule 16A11 compliant plan, then any other acquisitions through dividend reinvestment don't qualify for the exemption. The staff's position is if you have a 16A11 dividend reinvestment plan available to all stockholders, then if you have dividend reinvestment features of other accounts or of awards, those are essentially the same as dividend reinvestment, and they don't have to be reported on Form 4. So if, for example, you have dividend reinvestment features for your RSU awards, if you have DERs for your stock options, so that the number of derivative securities owned is increased each time there's a dividend reinvestment, if you have a Rule 16A11 plan, you don't need to report those either. But if you don't have a 16A11 compliant plan, then you do need to file a Form 4 for those acquisitions. There's really no way of avoiding having to file those Forms 4 for your executives or directors if it's a feature of an equity plan, because most companies are not likely or willing to give up the dividend reinvestment feature of their equity awards program. You just need to be prepared to file the Forms 4 as those DERs accrue. The thing to look out for, and which is a common failure to file a Form 4 on time and results in a lot of the Item 405 proxy statement disclosures that we talked about earlier, is that an executive will hold stock or a director will hold stock in a personal brokerage account and have failed to elect not to have dividends reinvested. And so there are quarterly acquisitions occurring, and often that isn't known to the compliance personnel. Even the executive or the director doesn't remember that that was a box that they checked on their account opening forms. And then at the end of the year, or maybe even later, when the company's doing its D&O questionnaire or otherwise trying to true up beneficial ownership, they find out that there have been these multiple quarterly acquisitions of stock that weren't reported on Form 4. So again, if the company has a Rule 16A11 compliant plan, you don't need to worry about that. You can let your executives and directors do whatever they want in their personal accounts. But if you don't, you need to make a decision whether to file a Form 4 for those executives who have a dividend reinvestment feature in their brokerage account, or this is much more common in my experience, just let all of your directors and executive officers know they can't check that box for dividend reinvestment in their brokerage account. It's just too dangerous or too burdensome to have to report on for those small acquisitions.
Appreciate that. That's fantastic insight. So with performance grants, these are common. I think most of us who work in equity compensation, work with this type of an award. They're very common, but they can also be pretty tricky sometimes. And I think the trickiness often relates to the performance conditions. And whether the conditions are related to the market, partially tied to the market, related to total shareholder return. There's some different things to think about here. So Alan, how do you look at performance grants?
Yeah, well, as you said, performance grants are somewhat complicated because they all contain different performance criteria or conditions. I mentioned earlier the letters that the staff issued in the early 90s to interpret the new rules. They issued at least a half a dozen letters addressing performance awards. And the general principle that the staff applies is any award that the vesting of which is subject to a material condition isn't reportable until that condition has been satisfied, subject to three exceptions. One, the passage of time, continued employment, the typical RSU award, or if the award is tied to the achievement of a particular stock price. So if your conditions are anything other than those three and they're material, which means they're not substantially likely to be satisfied, then the award isn't reportable at the time of grant. So as you were saying, Kristen, if you have, it could be EBITDA, it could be the company's earnings, whatever, or operational metrics of the company, which are that and particular financial performance criteria, not stock price, or the typical conditions to the vesting of performance awards, then the performance award is not reportable at the time of grant. Christian, you raised a really good point about total shareholder return. Well, a lot of awards, performance awards, will vest subject to achievement of particular total shareholder return. Well, is total shareholder return the equivalent of stock price, the achievement of a particular stock price, which would mean that's not a material condition under staff interpretations, and so you would need to report that performance award at the time of grant? Or is it subject to other conditions like the payment of dividends, which is not tied to the company's stock price? That question befuddled lawyers for a long time, and the SEC some years ago responded to an interpretive request and said, it depends. If you're a company that regularly pays dividends and the dividends may fluctuate or be suspended or passed over from time to time, then total shareholder return is not the same thing as the company's stock price. If, on the other hand, you're a company that's never paid a dividend, isn't planning to pay a dividend, to say that total shareholder return is a condition other than the achievement of the company's stock price is probably not right, and you should report the award at the time of grant. One other point to think about here at the bottom of the slide is performance as a vesting accelerator. The staff has made clear that if you have an option or a restricted stock award that vests based on the passage of time and continued employment, but you provide that if the company achieves certain performance metrics, then vesting will be accelerated. That's not a performance award. That's still an award subject to vesting based solely on the passage of time and continued employment, and so it needs to be granted. It needs to be reported on Form 4 at the time of the grant.
Appreciate that. Thank you, Alan. Trevin, what are your thoughts on performance grants?
I think performance grants make it so, from a stock administration standpoint, performance grants are hard to plan ahead for, because I think in addition to all the factors that Alan mentioned, there's also such a subjectivity or can be such a subjectivity in the way that those performance awards are granted. In previous life, I worked with a CEO who a lot of our performance metrics were tied to scientific achievements. And the CEO was the one who did the interpretation. So the scientists would say we only achieved 65% of our goal. The CEO could come in then later and say, no, let's make it 72. So I think that makes it really difficult from a timing perspective to really adequately understand exactly what you have to report in those instances. So I would just say, again, prepare early, prepare often, and probably have to redo it once or twice.
Yeah, that's a good point. It's triggered another thought on my part. When is a performance award earned? Typically a performance award provides that it's earned based on performance through 1, 2, 3 fiscal years. So on December 31 at midnight, the award is presumably earned, but you don't know that. or you can't get the Form 4 filed by January 2 or whatever the second business day is after that vesting. A common practice, and the staff, while I've never heard them address it, knows this is the practice that companies follow, is that the conditions to the achievement or to the vesting or earning of the award includes comp committee or some other committee's certification of the results, meeting and saying, okay, we agree that the financial metrics were met, and therefore we approve the payout of these awards. That's the date that companies use, and that I would recommend that a company use to start the 2-day clock for filing a Form 4.
That would have been so much more helpful.
Appreciate that. That's great stuff. Thank you. So, you will have times where your insiders will leave your company. And, from our perspective, it boils down to just having a good process in place. Often when we're working with new clients, we're onboarding, we're trying to look at a lot of these different procedures and sort of defining them in advance before the situation comes up, so that you can just pull that process off the shelf and use it when it happens. Alan, from a compliance and a regulatory standpoint, how do you look at the situation when they leave?
Well, there are a number of things that an insider needs to be, or former insider, departing insider needs to be aware of as potential compliance issues for that insider once he or she leaves the company. One is the potential Section 16 tail. The SEC's rules provide that a person who is no longer an officer or director may be subject to Section 16 for certain transactions post-termination. Generally, if there has been a non-16B exempt transaction within the 6 months prior to departure, a transaction post-termination could be reportable. To take a simple example, if an executive officer had, say, purchased stock in the open market within the 6 months prior to termination of service, and then terminates service and decides that I'm not with the company anymore, I'm going to liquidate my holdings. If the insider were to do that within 6 months of that purchase, that's a sale that's reportable on Form 4 and subject to matching under Section 16B and the profit recovery provisions. And so it's important that the insider be aware of that when the insider leaves. And it's important that the company be aware of that, because the company is responsible for making disclosures at the end of the year in the proxy statement of the 10K relating to compliance with Section 16A. So the company needs to be aware if that doesn't get reported. Obviously, you're not looking to find out if your insider actually sold stock. You want to keep the insider from engaging in a transaction that could be reportable, because if it's reportable, it's likely subject to Section 16B matching. And so insiders need to be made aware of that. Insiders also need to be aware of their obligations apart from Section 16, for example, under the insider trading policy. You may be in a blackout period, the insider might be in possession of material non-public information, and the insider needs that guidance. And from the company's perspective, the company wants to make sure that it has an effective insider trading program so that it informs its insiders, here are your obligations under the insider trading policy. And then the third compliance element I'd mention is Rule 144. This is one that it didn't exist until Rule 144 was amended in 2006 or 2007, but a former affiliate, assuming that your departing executive or your departing director is considered an affiliate of the company for purposes of Rule 144, and that's a judgment the company makes, and companies have different lists of who they consider to be affiliates, then for 90 days after leaving the company, the insider will need to file a Form 144 if the insider is going to make open market sales and the number of shares sold exceeds the threshold, $50,000 or 5,000 shares, for having to file a Form 144. Easy to talk about these issues among all of us because we deal with these rules all the time. Insiders aren't particularly familiar with all of these requirements. And so my view, and I believe this is nothing's a universal practice, it's a very common practice, is to have an exit memorandum to give to your offboarding executives as they're departing, have a memorandum that explains to them all of these obligations. And then in addition to that, having an exit interview, if that's possible, or maybe an exchange of emails to find out what the particular circumstances are for that insider, so you know whether there's a potential, say, Section 16 tail. if you look at your Form 4 history for that insider or talk with the insider and every transaction that they engaged in the 6 months prior to service, assuming there were any, if there were none, or if they were all exempt from Section 16B, you know that there isn't anything that that insider can do that would trigger an obligation to file a Form 4. On the other hand, you might see a transaction that makes you say, whoops, we might need to track this person. And so you want to make sure you have a mechanism in place for, making sure the insider is aware of that restriction, just in case he or she doesn't read the memo or doesn't understand the memo, so that you can then track for your Section 16A compliance.
Perfect. Thank you, Alan. So Trevin, from the stock admin perspective, what are your thoughts?
I love the idea of the exit memo. We are going through this very situation right now, and providing that exit memo has been extremely helpful. I also gave them kind of a shortened version of that and just said, anytime you do anything over the next 6 months, please reach out to us, let us know, and then our legal team and the stock admin team can decide whether or not we need to file on your behalf. So I think just communicating and kind of training those insiders as they're leaving what the appropriate actions are, and making sure they realize the severity of those actions, from a selling standpoint, and making sure they know that that tail could be applicable is really, really important.
Perfect. Appreciate that, Trevin. So just for us to be mindful, we have just a little bit over 10 minutes left. But did want to talk a little bit about, so conversely, you might have insiders that join your company. Alan, what are some key points for us to think about from a compliance and regulatory perspective?
Well, I think the most important thing when you're onboarding a new insider is to make sure you get the Edgar codes, first of all, as Trevin mentioned earlier, because you can't be sure how fast the SEC is going to act on that. And you don't want to be caught without Edgar codes and have a filing deadline for any of your Section 16 reports, because then you're stuck with a late filing. But getting the information together for the Form 3, getting a questionnaire of some sort, or otherwise gathering information to find out what the onboarding insider beneficially owns at the time. If it's somebody inside the company, you probably get that information easily. They may hold equity awards. If it's somebody new coming on the board, then that might be different. But giving them some kind of a questionnaire, an abbreviated version of the beneficial ownership question from the annual D&O questionnaire, and getting that information and getting it onto a Form 3 and then filed on time. One thing to be aware of is a lot of companies will have or do have an equity plan that provides that, say, if a new director is coming on board, as soon as that director comes on board, they become entitled to an equity award of some sort. So there's an immediate acquisition, or in connection with the promotion of somebody to executive officer, there might be an additional equity award. And that award under staff positions can't be included in the Form 3 as securities that are beneficially owned as of the date you become an insider. The Form 3 needs to show what the person owned immediately prior to becoming an insider. And when they get that initial grant, that has to be reported on a Form 4, which just circles back to the Edgar code issue. You don't really have 10 days in most circumstances to have those Edgar codes and make the filing, because you're going to have to file a Form 4 within 2 business days of the promotion date.
Appreciate that. Thank you. Thank you, Alan. Trevin?
Everything Alan said is key and most important, but I would also say, just again, educating and communicating with those new Section 16 officers, whether they're new board members who've never been a part of a board before, or if they are old school and have been doing this for a while, it's not a surprise to them. But new members, it can be a shock that they suddenly have to provide so much personal information, so much personal financial information, and just making sure they understand why this is happening and that you'll help them through the process is, I think, the thing that I found the most successful, is just to give them kind of a mini education on how important this is.
Appreciate that. Thank you, Trevin. Thank you both. So with this next piece, how to minimize errors in filing. I think we recognize, this work can be complicated. There can be a lot of people involved. There can be unique situations that come up. From our standpoint at SOS, we encourage you to think about setting up your filing procedures in a similar way that you would have the same rigor in setting up your SOX procedures, making sure that you don't have a single point of failure, having a second set of eyes, having the right tools, make sure that your partners are included in the process and know the roles and timelines. Another thing that I like is what I see in our teams is trying to think about how to be proactive in creating these forms. So if you have an event or activity that is coming up in advance, whether it's a release, whether it's even a 10b5-1 trade or a new award, creating the draft form, getting that completed, and then just go back and add the final details later. It can save you a lot of time and keep you from really feeling rushed. From the standpoint of kind of how we do this internally, just to kind of let you in on that, we have our internal team will create a draft. They save it in a shared folder. Basically use our Equitrax software to create a ticket that goes to their review team. The review team looks at it, compares to prior filings, looks at the supporting data, so forth, really making sure that it's good to go before it goes to the client for final review. So I say all that just to kind of point out that there's some good processes that need to be in place to think about how you handle this. And whether you have the staff we have, or even just 2 or 3 people, you can still work in some of those same key procedures, like making sure there's a second set of eyes, making sure that you have the right tools, making sure that you establish timelines and so forth can be very important as well. Trevin, what are your thoughts there?
I think that's, proactivity for me is key in getting things done in advance so that you, like you said, Christian, you only have to do that last double check of just, the last minute things that you're adding in. Like we were talking about with performance shares, you may not know those exact numbers till the last minute, but you know that you have a ticking clock that you have to meet a deadline with. So the other thing I would add in addition to this minimizing errors is be aware of who else is looking at these filings. I have a paralegal who had a great experience, or not so great experience, at Amazon. Jeff Bezos had filed a gift of 69,000 shares to someone. They filed this and they just so happened to file it at 4:20 p.m. Eastern. Bloomberg immediately took it as a joke with the number of shares that had been gifted, the timing of the filing, and then kind of connected the dots and called out that this was potentially an Elon Musk kind of weed data filing due to the time and the nature of the filing. And that's not the case, but you want to avoid anything that could cause undue exposure for your insiders, or, any additional call outs, or, nobody wants to be publicized for having kind of a funky filing.
Absolutely. Well said. So we do all we can. We have the right processes. We have the right people. People know what they're supposed to do. They have timelines in place, and mistakes still happen sometimes. We're all human, right? So Alan, how do you look at this when these things occur?
Yeah, look, this is a difficult area, I think, Christian, because it often requires the exercise of a fair amount of judgment, both on whether to amend and whether the failure to report correctly the first time is reportable or disclosable under item 405 in the 10K and proxy statement. To my knowledge, the staff has never addressed the question. The staff has from time to time spoken on panels about the kinds of errors they see in Forms 4, trying to educate compliance personnel about, getting rid of those errors. So, and they know, I think, if they're recognizing those errors, that not every error is being fixed with an amended Form 4. But it is common practice, and I think acceptable, when discovering an error in a Form 4 to do something like a materiality analysis, not just a Form 4, a Form 3, or a Form 5. And if a mistake has been made, and as you said, Christian, they get made all the time. If any of us sat down and looked through the Edgar system and picked out 25 Forms 4, I'm sure we would find some mistakes that are made in those. But ones that don't really mislead the public as to what Section 16 reports are intended to convey, to me, can fairly be characterized as immaterial and don't warrant an amendment. Again, there's nothing wrong with filing a Form 3, 4, or 5 to correct any error. So if you're inclined to do that, do it. But if you're not inclined, when you discover an error, to file an amendment to the report just because you don't want to call attention to it, you don't want to have to go to the insider and explain the error, or you don't want to confuse the public with another report that relates to the same transaction, then a materiality analysis, I think, is appropriate. And a lot of errors in Forms 4, in my mind, are not material. One that the staff highlighted in a panel I remember from years ago was they often would see a Form 4 file to report, say, an acquisition of 1,000 shares, but the acquisition will be reported in the column for D, dispositions. So the staff is reminding people that's an acquisition. Make sure you're keeping your columns consistent. In my mind, that's almost never a material error, because you can tell when you get over to column 5 and compare that column to the last Form 4, whether it was an acquisition or a disposition. So the information that the Form 4 is intended to convey, I think, is fairly obvious. And there are lots of other kinds of errors in reports that I think are not material. The question usually comes up because someone has failed to report the correct number of shares. You file a Form 4 to report, say, a sale of, you wanted to report 500,000 shares sold or 50,000 shares sold, and you reported 5,000 shares sold. It's just a typographical error, and that may have carried over to, and even if it did, it isn't clear where the mistake was. If it's a mistake in column 5 or it's a mistake in the column showing the number of shares disposed of. And in those cases, I think there's a greater likelihood that the error would be considered material. Again, I don't think these are easy judgments. It's always a judgment, and you have to take into account all the facts and circumstances in determining whether the error is material. But a material error, I think, clearly needs to be addressed. Immaterial errors can be more easily addressed by either ignoring them or explaining them in the next Form 4, just to keep the Section 16 reporting history clear. So you drop a footnote to your total and say, reflects the number of securities held, assuming that the transaction reported previously as a disposition was truly an acquisition or something like that. But all of those kinds of errors, if they weren't being addressed, the immaterial errors can be addressed in a footnote. Material errors are a different issue, and they require, I think, the filing of an amendment to the form that was not appropriately completed. That raises a question of item 405 disclosure. That's where the most difficult questions come up. The Q&A forum on section16.net that I administer is full of questions from people who said, this is what happened to me. I underreported a purchase by 50 shares or 1,000 shares, but the person owns 1 million shares. Is this immaterial? Because if you conclude that it was a material failure, then that becomes a failure to file a required report or the failure to report a required transaction on time. At least that's the staff position, and I think most of the bar takes that to be true, even though the initial report was filed on time. And so that's the importance of having to make that analysis. But again, I think all you can do is offer some guideposts for the materiality of the violation, and then make your determination whether you think you have an obligation to disclose under item 405.
Appreciate that, Alan. Thank you for that insight. Trevin, your thoughts?
I absolutely agree with Alan that the key is to decide whether or not it's material or not. The other thing I would also say as a consideration, at least from my end, is the visibility of these filings. So it's highly visible for those insiders whenever a form is filed, because it's public and it could create stir with shareholders, and nobody wants to make that big splash. So I think, when you're thinking about it, if it's not material, but you just wanted to cover your bases, think of the fact that there are other people who are looking at it and could really impact the opinions of the shareholders or outsiders.
Thank you. Appreciate you both. Great insight there. Well, thank you everybody for attending. I appreciate your time, and I hope this has been beneficial for you. And if you have any questions, please let us know. We'll be happy to reach back out and support you any way we can.
Like Christian said, thank you all so much for attending. Thank you to Trevin and Alan and Christian for this incredible presentation and this informative presentation. We're excited that you all attended. As Christian said, if you have any questions, please send an email to the email that you see on the screen, cbell@sos-team.com. For any questions. Thank you so much.
Thank you.
Thank you. Take care.